Auditors may be sued for negligence and fraud. In this video, we'll look at what defenses the auditor can use to defend against those claims. In lawsuits against auditors for negligence, the claim is typically that the auditor either failed to use due care, failed to follow generally accepted auditing standards, or failed to identify a material misstatement. The auditor can use the prudent person defense in response to the claim that the auditor did not use due care. This defense includes four things. One, the auditor possessed the requisite skills to evaluate accounting entries. Two, the auditor employed such skill with reasonable care and diligence. Three, the auditor undertook his tasks with good faith and integrity. Four, while the auditor may be liable for negligence, the auditor is not liable for errors in judgment. What is the auditor's defense in cases of negligence related to misstatements or fraud? Well, let's take a look. The lawsuit by a third party involves a claim that the auditor did not detect misstatement or fraud. The auditor's defense would require proof that the auditor did not have a duty to the third party. The third party was negligent. The work was performed in accordance with professional standards. The third party did not suffer a loss. The loss was caused by other events, or the statute of limitation has expired. As part of the auditor's defenses to negligent misrepresentation, the strict standard of McCamish is applied in determining who can assert a negligent representation claim. Adopting the McCamish standard of a known person for a known purpose to identify proper plaintiffs should reduce litigation against auditors, particularly by potential public investors. The audit client holds primary responsibility for the prevention and detection of fraud. So the auditor doesn't automatically carry the blame for not detecting fraud. The auditor has a responsibility to plan and perform the audit to obtain reasonable assurance about whether the financial statements are free of material misstatements, whether caused by fraud or error. Absolute assurance is not attainable, and even a carefully planned and performed audit may not detect a material misstatement resulting from fraud. A good defense to a claim of fraud is that there are no deficiencies in the audit procedures. However, the auditor may be liable if the audit procedures were inadequate to detect fraud. The claim of fraud requires an intent to deceive another party or a signer. In such cases, the auditor acted with knowledge of a false misrepresentation. Fraud is not the same as negligence. Where negligence may involve a careless statement, fraud requires the belief that representation was false and that it was made with reckless indifference to the truth. An auditor's defense against fraud begins with a claim that due care has been exercised and the auditor followed generally accepted auditing standards. Beyond that, the auditor must show that 1, the representation in question was not false, 2, the representation in question was not material, 3, the auditor did not know the representation was untrue, 4, there was no intent to deceive, 5, the third party did not rely on the representation, and 6, the third party did not suffer any damages. To avoid statutory liability for fraud, the auditor must demonstrate that he or she carefully considered fraud risks in the financial statement audit. In addition to exercising due care, the auditor should evaluate the conditions for fraud depicted in the fraud triangle.